Hey everyone, welcome back to the channel. Today we're doing an evaluation on Apple in 5 minutes. If you've been following Apple, you know recently they released their 2021 financial results, and they had a rather impressive year with 33% revenue growth while improving their margins overall. So let's go ahead and jump right into it, and let's see what this DCF is telling us. For 2022, what we've done is we've taken the 5-year CAGR, so we've taken the 5-year average return or growth from 17 to 2021 to get us 9.8%, and we've taken a conservative growth assumption and assumed that through the rest of the years they will just stay at this average rate of 10% for revenue growth. Now, the next thing we want to look at is Cogs. If we look at Cogs, you'll see we have it slightly improving. The reason we have this is because as the revenue's been growing, we've actually been seeing a little bit of a shift from product revenue into service revenue, and service revenue actually comes with better margin. The next thing you'll see SG&A, we have this just ever so slightly improving as well. Reason for that being is a company their size has a pretty well established corporate functions, and as the company continues to grow, SG&A costs will not scale linearly with the revenue growth. Tax rate, we've held at 21% as a corporate tax rate. You know, if policy changes, we could update this, but just leaving it at 21% to keep things simple. Next thing here is Capex. You'll see we're holding this at 3%, but on absolute dollar terms, it actually is growing when we do that. The reason for that being is it looks like they've been a little underspent on Capex in the past. I know it's been a higher percent of revenue, but if we look at the depreciation, you'll see in 19 and 20, depreciation was higher than Capex. Reason being is they kind of slowed down their Capex investment, probably just the pandemic, and they had some poor years on sales growth. So probably just being a little cautious there to not overinvest in times when revenue wasn't growing. But we've kind of adjusted for this and assumed it'll get back towards the 80% going forward. 80% is usually what we want. That shows a good growth between maintenance and growth Capex. That's what you'll kind of see, kind of a norm in Fortune 500 companies. The last thing is the working capital. You'll see 20 and 30% here. This is just kind of averages based off historical years. We don't want to overthink this. Reason being is, I mean, this is really just changes in cash flow driven by basically payment and collection terms, so accounts payable and accounts receivable, and their ability to control inventory levels. So all these assumptions, what are we told? Well, if we use a 10% weighted average cost of capital, and this really just represents what we require as a return as an investor. Don't overthink it. Don't go an academic route looking at risk-free rate and things like that. With, you know, the Fed holding rates at basically zero, you get really screwy cost of capitals of like 5 or 6%, which is just going to blow up your valuation, which just isn't realistic. So this is the required return as an investor that you need. I use 10%. You know, I think historically the S&P is like 10 to 11% before inflation. So that's kind of what this represents, right? After inflation, you get like a 7 to 8% return on the S&P. 3% terminal growth, pretty standard assumption, just kind of at the pace of inflation is what they'll grow after a decade. Obviously, they could continue to grow faster than that if they continue innovating. What does this give us? This gives us a terminal value of $2.4 trillion. Their current market cap is 2.5 trillion. And if we actually look at kind of our sensitivity table, 10% WACC, you get 2.2 to 2.7, just depending on what you kind of tweak the perpetuity growth at. So based off this, I think Apple is actually fairly valued. I think this is a great company. I think they've shown for the last, you know, since 2007 when the iPhone came out, they've shown that this is a product that's here to stay. They've transitioned into a service model as well, refreshed the Mac, things like that. It's been growing well. I think there's a lot of room for upside here, and I think, right, if you only require an 8% return, we're going to say they're undervalued, and there's room for growth here. So I think it's a great company. I think it's great products. I think consumers love it. I think they're fairly valued, and I think it'll be interesting to see how things kind of continue in the future. With all that said, please download the model. There's a link in the description below. Go in here, tweak some of the assumptions down here in this table. See what kind of valuation you get. You could, if you wanted to get crazy, you could break out revenues between product and service. You could go kind of one double click down on it. Historical income sheet, balance sheet, and statement of cash flows are all copied over in here for you based off their financials. And the DCF I pulled together back in January of this year is in here as well. You'll see back then we got about a 1.6 to 1.9 trillion dollar valuation. And, you know, we assumed a 10% growth in 2021. Obviously they blew that out of the water. They grew 33%. I thought, you know, coming off COVID, but they even grew in 2020, you know, maybe, you know, they double that growth, but it wouldn't be anything insane, but they showed otherwise. So there's been strong demand. So feel free to download this, tweak everything, and please leave any questions or comments you have below. Thanks for tuning in.